Welcome to the deep dive. So you've sent over some interesting stuff pointing us towards investment opportunities that maybe aren't getting the spotlight right now.
Yeah, definitely off the beaten path compared to the usual gruff stories.
Right. So our mission today is to really dig into two specific high-yield stocks that the source claims are, well, outrageously undervalued.
Mm-hmm.
And we're looking at this from an individual investor's angle, which is, a bit different, looking beyond just the big growth narratives.
Exactly. So the two companies are Medical Properties Trust, that's MPW.
Hospital real estate, right?
Yep. And the other is Altria Group, MO, tobacco, nicotine products. Very different businesses.
Totally different. But both flagged as potentially having this, hidden value the market's missing.
That's the core idea.
And the source sets this up nicely, acknowledging, the excitement around high-growth stocks.
The shiny objects.
Yeah, exactly. But then it shifts focus, saying maybe the real chances, the steadier ones, are in these value stocks, these dividend payers people are ignoring.
It's a classic value investing theme, really. Looking where others aren't.
Okay, let's jump into MPW first. The source hits you with this huge dividend yield, like 12%.
Around that, yeah. It fluctuates, but it's high.
And calls it the zombie that won't die. I mean,
Whoa.
that grabs your attention.
It certainly does. Paints a picture, doesn't it? Market thinks it's got issues, big ones maybe, but it's still hanging on.
So its main business is owning hospital buildings.
That's it. They own the physical properties, the hospitals, and then they lease them out to operators who run the hospitals. Their income is the rent.
Simple enough, but it sounds like things haven't been great lately. The source is pretty upfront about problems.
Oh, yeah. No sugarcoating. They mention tenants struggling, some going bankrupt even.
Bankruptcies, woof.
Yeah, and credit downgrades for MPW itself, and just generally negative sentiment. You see it online, too.
I saw that note about MPWTO $0 popping up on forums. That sounds, pretty bleak.
It does sound dire, and, that extreme pessimism is exactly what often interests a value investor.
Right, the contrarian angle.
Exactly. So despite all these very real challenges, the author is actually buying the stock.
Okay, that's bold.
Their main point is that maybe the fear, the negativity has just gone too far, that the market reaction is overcooked, as they put it.
Overcooked. Okay.
Yeah.
So what makes them think it's not just, catching a falling knife? What positive steps has MPW actually taken?
Well, the source points to a few things. MPW hasn't just been sitting there. They've been selling assets over $2 billion worth in 2023.
$2 billion. Okay. So that brings in cash.
Brings in cash, reduces exposure maybe to weaker properties. Plus, they've been working on refinancing debt, pushing out maturities.
And fixing up leases with tenants.
And restructuring leases, yeah. Trying to make things more sustainable for everyone. These are all steps you take when you're, under pressure but fighting back.
And the valuation is key to this whole argument too, isn't it? They talk about price to FFO, funds from operations,
right,
being down around 4 times forward FFO. Maybe explain FFO quickly and why 4 times is low.
Sure. FFO is basically a better measure of cash flow for real estate investment trusts, REITs, than just net income. It adds back depreciation, amortization, things like that.
Right.
And typically, a healthy REIT might trade somewhere between, say, 12 to 15 times its FFO, maybe higher, maybe a bit lower, but in that ballpark.
So 4 times is really low.
It's extremely low. It suggests the market has almost zero expectation for future growth, or maybe even expects things to get worse. The author sees that as a massive discount.
Like all the bad news is already baked into the price.
Pretty much. The market seems to be pricing in a lot of negativity, maybe too much.
And here's where it gets really interesting for an income investor. Even with all this risk, the dividend, it got cut, right? We should be clear on that.
Yes, absolutely. They did cut the dividend significantly. That already happened.
But even after that cut, the source suggests the yield could still be, over 6%?
Yeah, potentially still a very substantial yield, even post-cut. That's still a decent income stream while you wait.
Which leads to that whole blood in the streets idea.
Exactly. Classic value investing. When there's maximum fear, that's when you might find the biggest bargains, assuming the company survives and recovers.
Because everyone else is running away.
Right. The author is basically saying the price is so beaten down that the potential reward, especially with that dividend, compensates for the uncertainty. They even mention that old Rothschild saying,
buy when there's blood in the streets.
Even if it's your own. Yeah, that kind of extreme sentiment.
So the thesis is basically MPW is beaten up, maybe for good reason, but they're fighting back, and the price is so low it might be a turnaround play, a redemption arc.
That's a good way to put it, a redemption arc. The market's largely written it off, but the investor thinks the underlying assets hospitals are pretty essential after all.
Yeah, you'd think.
Still have value, and management's actions could lead to a recovery. Could. Big question mark there, obviously.
Okay, let's switch gears. Altria, MO. This one's different, brings its own baggage maybe. The source had that little think of the children aside.
Yeah. It's tobacco. Always controversial.
But the numbers the author throws out are interesting. 9.3% yield, PE ratio around 8.2, huge company.
Massive market cap. And yeah, that description, consistent cash machine.
That jumps out.
And Altria really has earned that reputation for dividends. The source notes, 58 dividend increases in 54 years?
Wow, 58 times.
Yeah. Through recessions, lawsuits, smoking bans, they just keep paying and raising that dividend. It says a lot about the cash flow.
And those profit margins, over 70% gross margin.
Incredible, isn't it? It really shows the economics of the traditional cigarette business. Low cost to make, strong pricing power.
Even though fewer people are smoking overall.
Absolutely. That's the counterintuitive part. Volumes decline, but they raise prices, and nicotine is, addictive. So they've managed to keep profits flowing.
But that melting ice cube thing is real, isn't it? Smoking is declining long term. How does Altria deal with that? You can't just raise prices forever.
That's the absolute key question for their future. And the source lays out their strategy. They're still using that pricing power on cigarettes, but they're also pivoting hard.
Towards?
Non-combustibles. Things like their on nicotine pouches, which are growing fast. Their partnership with NJOY for vaping. That's their bet after the Juul situation didn't work out as planned.
Right. The Juul investment was a bit of a mess.
It was. So NJOY is the new focus there. Plus, they have investments in cannabis, heated tobacco products. They're trying to move beyond just cigarettes.
Becoming more of a general nicotine or even broader alternative products company?
Exactly. Trying to capture smoker switching or new users of these other forms. The big if is whether these new areas can be as profitable as cigarettes were.
Makes sense. And yet, even with this strategy and the profits, the valuation is still low compared to the overall market, like 8 times earnings versus 20 for the S&P 500.
Yeah, a really significant discount. And again, the author sees that as sentiment. The market's focused on the cigarette volume declines, maybe ignoring the cash flow, maybe underestimating the potential of these new products.
So it's another case of negative perception potentially creating an opportunity.
That's the argument, an opportunity born from negativity.
So looking at both MPW and MO together, the connecting theme is really this negative market sentiment, isn't it? Both are kind of hated stocks.
Yeah, hated seems about right for the current mood. And that unpopularity is exactly what the author finds attractive. It creates that potential gap between price and actual value.
Well, everyone else is chasing the clean, shiny growth stocks.
Right. These are the less glamorous plays, but the bet is that eventually fundamentals matter, cash flow matters, profits matter, and the market might swing back to recognizing that.
And for both, the cash flows are strong and the dividends are high. That seems crucial to the thesis.
It really is. Even if the stock price just bumps along sideways for a while, you're collecting that significant yield. It's a tangible return.
But we have to acknowledge the risks are real too, right? The market isn't negative for no reason.
Absolutely not. For MPW, it's line source.
Yeah.
Can they really turn things around? Will their tenants stay stable? For Altria, can they manage the cigarette decline? Will the new products actually take off and be profitable? And, potential regulation is always hanging over tobacco.
But the core argument from the source is that those risks, they're already reflected in the price.
That's the value investor's bet, that the market has already priced in the bad stuff, maybe even overpriced it in. So the downside might be limited, while the upside, if things go right, could be pretty good.
Identifying that gap where pessimism has gone too far.
That's the goal.
The source also touched on the author's personal strategy. It wasn't just go all in.
No, it sounded quite measured. Dollar cost averaging for both.
Spreading out the buys.
Right. Reducing timing risk. For MPW, reinvesting dividends, but also having price targets where they'd buy more, suggesting they expect volatility.
Okay.
For Altria, it sounded more like building a long-term income position, reinvesting dividends automatically, but also having a lower price point where they might buy more aggressively.
So a long-term view focused on income, but ready to buy more if prices dip.
Seems like it. Commitment, but with discipline.
Let's think about the upside then. What could go right here for MPW?
Well, Tenants stabilize. Maybe the restructuring works better than expected. They sell more assets, pay down debt faster.
Confidence comes back.
Confidence returns. And maybe down the line, they even feel secure enough to start raising the dividend again. Any of that could trigger a big re-rating of the stock, back towards a more normal REIT valuation.
Which would mean a nice price jump from these levels.
Potentially quite significant. Yeah.
And for Altria, what's the good scenario?
Success in that transition. The on-pouches keep growing strongly. NJY gains traction in vaping. Maybe heated tobacco takes off.
They actually grow revenue again.
Yeah, they show they can grow revenue and profits even as cigarettes fade. If that happens, the market might say, okay, this isn't just a melting ice cube, and that PE multiple could expand quite a bit.
Closing that gap with the broader market.
Exactly. People start seeing it as a stable, maybe even slightly growing consumer staples company again, not just a declining cigarette seller.
And all the while, the author stresses, you're collecting those dividends.
Getting paid to wait, essentially. That yield provides a cushion and a return while you see if the turnaround or transition story plays out.
Okay, so wrapping up this deep dive, the core idea we've unpacked is that, while everyone's chasing growth, there might be real value hiding in plain sight with unpopular companies like MPW and MO.
Yeah, companies facing headwinds, definitely negative sentiment.
But generating serious cash, paying high dividends, and maybe, just maybe, priced too low because of all that negativity.
That's the argument in a nutshell. They're not flashy, but they're real businesses, making real money, potentially on sale.
Which brings us to that final thought from the source, that analogy. MPW and MO as the wallflowers at a high school dance.
Yeah, I like that one.
It makes you think, doesn't it? Maybe the best opportunities aren't always the most popular ones. Perhaps it's worth looking away from the hype, exploring those unloved corners of the market for value and income. Makes you wonder, what other wallflowers are out there?